US unemployment rises again, bolstering bets for big Fed cuts. Welcome to Market Insights. I'm Peter Devlin. US job growth slowed, over 60,000 jobs less than expected in July, heightening fears that the labour market is deteriorating. Non-farm payrolls increased by 114,000 jobs, while the unemployment rate rose to 4.3%. That's the highest since October 2021. Investor anxiety about US economic slowdown sent shockwaves through markets, already rattled by downbeat earnings from Amazon and Intel. So investors are now questioning whether the Federal Reserve has held rates steady for too long. Joining me now to talk about all that is Peter Andersen, founder and portfolio manager at Andersen Capital Management. Welcome, Peter. A fourth straight monthly increase for unemployment. Is a soft landing now out of reach?
I am still in the camp of a soft landing. You know, these are data points that we need to take in stride, actually. I know that sounds a little cavalier, but this data that we're looking at, there's a lot of error rates in it, and people have come to treat it as a scientific fact. So my advice is to just relax a little. There's always noise in these numbers. A lot of other people don't agree with me, but believe me, there are. Even we know that the Fed, when they take surveys, for instance, they're still using landlines as an example and planning to change over to cell phones. So while it, of course, is a little bit of concern, I think in general you have to relax a bit, take the data in stride, and look at a bigger picture rather than just the isolated economic data of employment.
Some traders not as optimistic as you though, Peter, as traders boosted bets of big Fed cuts after the print. Can a 50 basis points cut be warranted in September?
Wow, I am reeling at the thought of 50 basis points, even half of that. I'm in the camp that I think the Fed has not waited too long. I think they've done a very good measured job. They're taking their time looking at this data, and I also don't believe that this portends a recession the way we're hearing so much negativity about this. It's astonishing to me that this one data point released today can have such an impact, especially on tech stocks, which, if you are a supporter of a Fed rate cut, you would also think to yourself, well, lower rates usually means a better, friendlier environment for tech stocks. So right now, a lot of this doesn't make sense. We're kind of stuck in the middle of a storm of trading today.
So keeping with those big tech stocks you mentioned, and they've also failed to convince Wall Street that AI costs are paying off. How convinced are you?
I am growing more convinced that there is probably going to be considered overspending. So far, we've been very patient with the build out in the CapEx, but to be honest, we're not seeing much of that return yet, are we? And so as time goes on, there is more pressure on the CEOs of these companies to actually produce tangible examples. Tangible examples. So far now, if you ask most of these CEOs, embarrassingly, they struggle to articulate the benefit of AI. So this could all come to frankly, a disappointing conclusion. We don't know when that will happen, but I know it is in the pipeline for us to make a major attitude adjustment as to how powerful AI is going to be to society and also to businesses.
One of those benefiting from the AI push has been chipmakers. So how vulnerable is this sector with your view in mind?
Quite vulnerable. You know, we've been talking about the so-called pick and shovel model that invests in a company like NVIDIA, which I still hold, but I have radically reduced the exposure. So while that argument can work, if the gold rush ends and you're stuck with picks and shovels, it's not going to do much for you in the future. So my word of caution is, right now, we are very close to coming to a conclusion as to whether or not this is a valuable investment. You know, it's projected that companies will spend $1 trillion in this build out. And shades of, for those that have been around long enough to remember, shades of the fiber optic overbuild in the early, actually it was around 2000, comes to mind, where we built so much fiber optic cable expecting that the usage would be there, and it never really did fulfill, and we saw a tremendous sell-off as a result of that.
Interesting. And now on to next week, and earnings continue to roll in. Disney, Caterpillar, and Eli Lilly all due up. So what do we think the market be looking up for, and in terms for the rest of this earnings season?
I think that once we digest the so-called bad news of the economic job report today, Monday's a fresh day. The market seems to have a very short-term memory. So they'll be looking at these companies. Ironically, they'll be looking to see what all these companies will be saying about AI. You know, John Deere and the rest of them, they all feel compelled to throw in the phrase AI, which is also a little bit reminiscent of the late 90s when people were throwing in the .com phrase to their companies. So what I'll be looking at is all these companies, what they might be saying. All it will take is one company to say something like this negative. We've spent as much as we want on AI. Even if they say something as strong as, and it hasn't fulfilled our expectations. Can you imagine if that were to come out? I don't think they'll say that, but they might hint that their capital expenditures on AI has peaked and they're going to decrease over time. That's what we should be looking for next week.
Peter Andersen at Andersen Capital Management, thank you very much for your thoughts. That is your market insights. You can watch more videos on Reuters.com.